The Roth IRA is one of the best investment accounts you could use to build tax-free wealth for your retirement. And if you follow each of the 5 simple rules that I'm about to mention in this video, I have no doubts you'll have much more confidence to building a killer Roth IRA. Now, before we dive deep into this, to sum up what a Roth IRA is, the term IRA stands for an individual retirement account, which means you can have complete control over the account and the investments you choose. Then the term Roth refers to the structure of the account, which is what determines the tax benefits, because with a Roth IRA, although the money you contribute into the account has to be taxed in the year up front, as you invest over time and have your investments grow, you get to avoid taxes entirely, and once you reach the eligible age of 59 and a half or above, everything in the account is completely tax-free, assuming it's been 5 years since you first contributed into the account. But knowing that, my name is Sully, and all I ask is if you do find value in this video, that you consider hitting the like and subscribe button for future content like this. With that said, the first simple rule to building a killer Roth IRA is to start investing ASAP. While it might sound simple, to some it could be really difficult to take that first step forward, and the most important thing I'd say to realize here is that most accounts allow you to start with any amount that you want, so even a few dollars and knowing the fact that you've officially created and started the account, it could really open up your eyes toward the right direction. But the main reason why starting right away is so important is because time is your greatest asset, and the longer you allow your money to be invested, the easier it becomes to build a killer investment portfolio. This is because of what's called the power of compound interest, which pretty much means as you invest over time, your money grows, and that additional growth can lead to more and more growth over time, creating a compounding effect on your money. A simple image here shows 3 different scenarios, where the first is Jack, who invests $200 per month starting at age 25, Jill, who invests $200 every month starting at 35, and Joey, who does the same starting at age 45, where you can see the outcomes for Jack and Blue show a significantly higher difference due to having more time in the market. Another interesting example to compare here is where Jack invests $200 every month between ages 25 to 35, where Jill invests $200 every month from 35 to 65, and crazy enough, looking at the charts, Jack, who only invested for 10 years and stopped at age 35, was still able to outgrow Jill by retirement even after Jill invested for 30 years straight. In fact, another interesting point based on this example is that after 10 years of investing, your investments will start making more money than the amount you contribute. And by the way, when you first start investing, you have to contribute much more into your portfolio in order to start seeing the growth, but after years of consistently doing this, there comes a point where the total earnings you gain outpace the total amount you contributed throughout the years. And as you can see, the contributions you make today can become big earners down the road, and this is why starting as soon as you can significantly improve your odds of a successful retirement. So whether you think you're too young, too old, or nervous to invest your money, remember, the longer you wait, the more you could be missing out later on. But after understanding the importance to start as soon as you possibly can, you now have to follow the simple rule number 2, that is to automate your investments. A popular term here that many refer to is called dollar cost averaging, which pretty much means that you are setting up a strategy to invest a certain amount of money on a recurring basis, like every week, 2 weeks, or monthly. The best way to think of this is like another bill that you have to pay, so every paycheck that you earn, you're putting a specific amount of money into your investments. Now, if you didn't know, the Roth IRA has limits on how much you can contribute into the account, but for the year of 2025, if you're under the age of 50, the most you can do is $7,000, and if you're above 50, you can do an extra $1,000. So let's say that you're 30 and the most you can do is $7,000 in a year. That would be $583 per month in order to reach that point. And let's just say that you get paid every 2 weeks. You could have $290 every paycheck be set up to automatically invest for you, which would allow you to reach your limit every single year without having to do nearly anything. A quick note on this as well is that the contribution limits also increase over time with inflation, so in a few years it could easily be higher than what you're seeing today. And also, if you can't reach the contribution limits, whether you can afford $10, $50, or $100 per month, whatever you can do is much better than doing nothing, and you're at least getting started in the right direction with your finances. Which, by the way, with a Roth IRA, you can make contributions up until the tax year's deadline, so for the 2025 contributions, you can make those contributions up until April 15th 15th of 2026. And while I'm on the topic of automating investments, remember, the more that you can consistently do over time, the larger of an impact the power of compound interest can have for you. For instance, this chart here shows different examples of someone who invests from age 20 until they're 65, averaging the same 7% annual return from earlier, where if you do $200 per month, you could end with roughly $760,000. If you up that to $500 per month, that makes it close to $2 million. And even though the rest of the data points are past the Roth IRA limits, let's just say you're investing in a 401k or other accounts, a total of $750 per month would be close to $3 million. $1,000 per month would be $4 million. And if you did $1,900, which was just recently the 401k's maximum limit last year, then you could end with over a $7 million portfolio. Above all factors to be considered, the most important number for a successful retirement is your savings rate, which is how much you can save based on your income. I recently made a video on that. If you want to check it out after this video, I'll have it linked in the description below. But now that you understand the benefit of simply starting as soon as you possibly can and investing on a recurring basis for the long term, the next rule, number 3, is to invest for long-term growth. Now, I'm not a financial advisor and you have to make your own financial decisions, but for many of you, you still have at least 10 to 15 years until you can even touch the funds in your Roth IRA that is at least tax and penalty free. Because of that, I highly encourage you to understand exactly what you are investing into, because even a 1% difference over many years of investing can have a huge impact on your future wealth, and I'll show real calculations on that near the end of the video. But the reason I'm mentioning this is because at the beginning of investing in my Roth IRA, I felt that I had to optimally allocate a portfolio, and so I included a small portion of bonds. All in all, I came to realize that my strong index funds did significantly better, and I'm still over 30 years away from even being able to touch the funds in the Roth IRA tax-free at the eligible age. So besides bond investing at a super young age, another scenario I've seen many others do in a Roth IRA is actually invest into dividends, thinking that the income can boost overall growth more for their future. While dividends can be a great choice, especially in an account like this because you get to avoid taxes, I've done plenty of research and created an entire video explaining the reality of dividends and how if you are investing for long-term growth stocks historically have proven to be superior. Of course, everyone's choices and opinions are going to be different, but the strategy I personally believe is best with a Roth IRA is to invest for growth now in the younger years to build up a killer Roth IRA so that later on you can reap a tax-free dividend income while having the entire portfolio sustain value and even growing larger and larger while you reap that tax-free dividend income. Now, I made many more videos on this topic, so I'm going to keep this short, but I believe a great starting point as a foundation to nearly any portfolio would be with broad-based index funds like the S&P 500 that would allow you to gain exposure to 500 of the largest publicly traded US-based companies all within one purchase. But leading off from that, the next simple rule to follow is to diversify wisely. You see, the goal when it comes to investing in the stock market is to maximize your potential returns while minimizing the downside risk of losing money. For instance, to have the opportunity to outperform the market, you have to take on more risk. So if you invest into your 5 favorite individual stocks, you can potentially grow your portfolio 50% in 1 year, but your portfolio could also decline 50%. Even worse, say just one of the 5 individual stocks goes bankrupt, this could really impact your portfolio's long-term performance. And remember, you are limited on how much you can contribute into a Roth IRA. In fact, it's reported that only about a fifth of stocks survive and outperform the market over 20-year periods, and even a blindfolded monkey throwing darts at a financial newspaper could select a portfolio that would do just as well as ones carefully selected by experts. On the other hand, say that you are nervous to invest in stocks and you put everything into bonds, you may return 4% after a full year with the benefit of nearly no risk of losing value. Except I personally would say your portfolio still has huge risk because depending on your position, you could be missing out on significant opportunities to earn much more, and yet alone you'd barely be keeping up with inflation. This is exactly why it's crucial to understand exactly what you are invested into, because if you're only invested into individual stocks, your retirement could be a gamble, and if you're only into bonds, you likely won't have enough to retire off of. That alone plays a huge part in why I highly recommend index funds, because you can control what market segments you're exposed to, giving you the opportunity for strong potential returns while minimizing the risk as you invest long term. Diversification and understanding how to optimally invest invest is crucial and a huge reason why I create the content I do and the startup I'm currently working on. But all in all, rather than going all in on one stock or relying solely on bonds, understanding your position and how much of a calculated risk you are willing to take can really help your investments grow properly and reduce the downside risks. Now, as you invest long term, the next rule can save you a ton of money, and that is to keep the cost low. By keeping the cost low on your investments, this could easily save nearly anyone watching this hundreds of thousands of dollars over time. The reason is because your investments compound over time, and when we look in terms of decades, the impact from fees becomes massive. For example, if you have an initial $10,000 and you start investing $500 per month into the stock market, averaging the benchmark of 10% per year with a 1% annual expense, over 30 years, that would cost you $210,000, resulting in an end portfolio of $950,000. That still might sound good to some, but if you instead put that into a low-cost index fund like the S&P 500 I mentioned earlier, let's say the ticker VOO, that has a 0.03% expense ratio, with that same example but now with VOO, the total cost after 30 years would be $7,000, resulting in an end portfolio of just over $1.1 million. That means you'd have over $200,000 more in your pocket rather than going to big companies in fees. And that difference can be even larger depending on when you start, how much you invest, and then when it comes to the fees, the investments you choose, and whether or not you have an advisor manage your money. That can have a huge impact on how much is taken out over time. But all in all, the simplest way to keep costs low and improve the odds of building a killer Roth IRA for your future, in my opinion, is to manage your own investments and invest into strong, low-cost index funds. You really only need at most a handful of index funds, and what's interesting is that an article by CNBC says how all you need is one to build wealth over time, mentioning a total stock market index fund that pretty much tracks the broad scope of the US economy, all within one purchase. But I want to emphasize that because index funds don't employ a high-priced manager or team of analysts to run things, they have very few costs and therefore come with much lower fees. Not to mention, but a broad-based index fund that tracks the US economy in one purchase has also proven for many years to do very well for investors, and those are just a few of the main reasons why majority of the investments I own are in broad-based index funds that typically stay under 0.05 to 0.1% of an expense, which is super cheap, especially for what you get out of it. So as far as keeping costs low, if you can save 1 to 2% a year in fees, remember that doing this throughout your career could easily allow you to have hundreds of thousands of dollars more in your pocket later on, which could be completely tax-free with a Roth IRA. Now, if investing seems too difficult or confusing, just remember these 5 simple rules that are to start investing as soon as possible, automate your investments, invest for long-term growth, especially if retirement is still many years away, and regardless of that, remember to diversify wisely and keep cost low. If you want to learn more on topics similar to this, I'll have other relevant videos and resources I created linked in the description below. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.